Well, good afternoon. This is Ed Meisegland, Managing Partner of Indiana Business Advisors, and I want to welcome you to something we did about 10 months ago with the same guy. And at that time, there was a bunch of panic on, not that there isn't now, but there was it was pretty intense on what was going to happen because none of us had ever experienced a pandemic like we've been going through. And at that time, we had John Randall, and we have John Randall back because the Economic Aid Act was ratified in December, and so there's been some changes. So John Randall, long time friend of the firm. You know, we've been blessed here in Indianapolis to have a number of really strong banking relationships, and John is at the top of the heap. He has just always been our go-to guy, and he continues to just help people get into business. And so we have John back. And so John, welcome. And would you mind telling us a little bit about Live Oak Bank and the work you're doing, and then let's get moving.
Ed, thanks so much. Really happy to be back sharing some exciting things that I think can help everybody that's in business and that wants to be in business. I'm happy to share a little bit about me and a little bit about Live Oak, but ultimately today I just wanted to share some things that if I was looking to buy or expand or even sell, some things that I would want to know out of the latest bill. So we'll cover what was in the act, what changed in SBA financing, what changed in regards to PPP financing, and kind of some of the impacts to payments and even the tax impacts that were affected. Just for way of background, I work for Live Oak Bank. We're the #1 SBA lender in the country, and that we do more dollars than any other lender. And we really got there by just trying to answer two questions really simply. We figured out all that people want to know is, am I approved and when will I get my money? So we try to answer those quick, and it's worked out well. In 10 short years, we became the #1 SBA lender in the country. I've had the chance to be doing SBA loans for 20 years, and I've got to tell you, Ed, this is by far the most exciting 12-month stretch I've seen in that time.
Hey, John, wait 1 second. And forgive me, I failed to mention that if one of the benefits that doing a webinar like this that we have is that you get to ask questions. So in your chat, if you have any questions as we go along, we will certainly answer them as we go. And for whatever reason, if we go long, we go long. And I wanted to make sure everyone understood that we will be recording this, and should for whatever reason you need to go or you have technical difficulties, the recording will be out by the end of the day. So sorry for the interruption, John, continue.
No, that's perfect. So on December 27th, the next economic aid package was passed and signed by President Trump at the time. It included lots and lots of provisions, lots and lots of pages, and I tried to distill it down to what's important to somebody that's in business with SBA financing or wants to be in business with SBA financing. But before I get there, it did include a second round of Paycheck Protection Program funding, which I'm sure most everybody's aware of. It was a little bit different qualifier than the last round of PPP. Essentially, it said if in any given quarter in 2020, your revenue was down by 25% versus the same quarter of 2019, you could get another 2.5 months of payroll loan that's once again forgivable. And what banks across the country have seen is that 30 to 40% of their round one PPP borrowers have qualified and applied. If you do qualify, I would encourage you to apply as quickly as possible. Theoretically, there's plenty of funding, but there was a clause in this bill that said these programs were available until the SBA incoming administrator determined they were no longer needed or funds run out. So if you think you qualify, reach out for help, apply, and get another round of funding.
And one thing to add on that I didn't know, and I don't think a lot of people knew on round one, is that even if you're a sole proprietor, you qualify for this, and that it's just not you pigeonholed to C's and S corps and LLCs. This is for truly, if you're in business, this is a viable option for you. So do take advantage of it.
I think that's a really good point. When round one started, there were a lot of rules that changed over time. And even if you're the only employee of your company or you're a sole proprietor, you're fully eligible. So absolutely go for it. The second really big thing that was in this December 27th bill that I think we should all be really happy about is that it spelled out in simple language so the IRS or any other group can't interpret it differently, is both the PPP funds and any free SBA loan payments to apply to your SBA loan are tax-free. And there's been a lot of uncertainty up to that point, and I know it was late in the year to finally know, but it was great news to learn that both historical payments that were coming in and payments that you get in 2021 will be tax-free. The next big piece applied to existing SBA loans that were in place prior to COVID. So prior to March of 2020, they had already received 6 months free payments. They're going to get another round of free payments, another 3 months free for those existing loans that were in place prior to COVID, up to $9,000 a month. So lots of good news for people that already had PPP loans or that are eligible for new ones or that already had SBA loans. But to me, the best news of all as a potential buyer is this next provision of the Economic Aid Act. It said that anybody that does an SBA loan between February of this year, so starting right now, and September 30th, gets up to 6 months of free payments at $9,000 a month. So as long as you close this loan while funds are still available, you're eligible for up to $54,000 in free payments. And I know everybody says there's no free lunch, but it clarified they're actually tax-free free payments of up to $9,000 a month for doing a new SBA loan. They combined that with waiving the SBA guarantee fee, which is a 2 to 3% savings on a new SBA business acquisition loan. I'll show you an example in just a minute of those total savings, but all those things combined with the normal SBA program of fully amortizing loans with no balloon payments, funding for an acquisition that also includes working capital or moving expenses or new equipment or whatever you need to make that business succeed. Loan amounts up to $5 million, long amortizations, 10 years on straight business acquisitions and 25 years on real estate with very flexible prepayment terms. I honestly believe that in my 20 years of SBA lending, there's never been a better time to get an SBA loan.
John, that brings me to a point on some of the smaller businesses. If they reduce the amortization, from 10 years to 5 years and take advantage of that $9,000. I mean, can you do it that way, or do you have to take the 10 years that you likely have come back with, or can we reduce the total amortization?
So in theory, we could reduce the total amortization. I think in practice, we're going to find on a lot of these, in order for the loan to cash flow to hit the lender's debt service coverage requirement, it's going to be difficult to shorten them too much unless you're buying a business at a huge discount. The SBA has come out and said that you can't do a shorter term just to take advantage of larger free payments. But that doesn't mean that maybe in a partner buyout situation where you're buying out a 50% partner, that maybe it wouldn't make sense to do a shorter term.
Yeah.
Good question. And I think we just need to address them on a case by case basis.
Got it.
So I wanted to show an example of the total savings that this Economic Aid Act allows a buyer. And I just picked a sample size of a $2 million loan. The interest rate stayed the same, but you get 6 months of subsidy payments or 6 free payments of up to $9,000 a month. The guarantee fee goes away. Your monthly payment drops almost $600 a month because the guarantee fee is not included in the loan amount. The total payment savings over the life of a loan on a $2 million loan is about $125,000. That's true cash benefit to a buyer that's moving forward between now and September. And just for perspective, on a $1 million loan, it's still over $100,000 in savings. And on a $5 million loan, the largest SBA 7A loan available, it's almost $240,000 in savings.
And the interest rate is the max you can charge is what, 2 3/4 over prime, right? So that's where you got because prime's at what, 3 1/4 right now?
That's correct. So my assumption here is this is a loan with mostly goodwill, very little collateral. Sure. And most of these will be between 5.5% and 6%. I just wanted to show a reasonable assumption. Good questions. For anybody that's curious, why would I do an SBA loan instead of a conventional loan? I do think that's a good point. Most conventional loans require both cash flow and collateral to back the whole loan amount. The benefit of the SBA loan is that you can finance goodwill or the intangible amount of the business value without collateral to back it up, which is why most folks end up going down the path of an SBA loan when financing a business acquisition. And some lenders will cap the amount of collateral shortfall that they're willing to accept. So be sure you're talking to your lender about what's the maximum amount. It might be 500,000 or $1 million or 2 million. I'm blessed to work for a lender where there is no cap. We're okay with a $5 million loan with no collateral.
Well, speaking of other lenders, and you're always generous with the information, but one of the things I think, and I don't know if it's on one of the other slides, is that there's the guarantee has gone, the lender guarantee, which and you can probably talk more about it than me, but has gone from 75% to 90%. And so if you have a particular lender that you're working with, their exposure has been reduced by that 15%. So to me, that if the risk exposure to that bank has been lessened, it should make lending to you, the buyer, more favorable, right, John?
Absolutely. The SBA has been careful to say, don't go and approve a whole bunch of loans that you wouldn't have approved at 75% guarantee and then approve them with a 90% guarantee, because the SBA doesn't want a lot more risk placed on the administration. That being said, a lot of banks sell their SBA loans, which means now they can sell 90% of the loan instead of 75, which means a bank that before was limited to the amount of loans they could sell because the amount of capital they had, now they can sell a lot more loans, which means they can go back and lend that money over and over again. So this was a great lever that Congress pulled that should allow all community banks and large commercial banks to do a lot more business loans faster. Just for background, there were about 1,700 SBA lenders, SBA 7A lenders, that did loans in the SBA's fiscal year last year. So there's a lot. I mean, that covers a lot of banks and a lot of locations. but the top 50 of those did half the total loan volume. So the top 50 banks out of 1,700 did half of all those transactions. And the only reason I bring that up is that means there's about 1,650 lenders that did not very many SBA loans on an individual basis. If you want a smooth process, if you want a term sheet or a proposal letter that matches the eventual approval, and you want a quick process with straightforward answers, I highly encourage you to work with one of the top SBA lenders in the country. And it's okay to ask, whichever lender you're working with, how many loans they did last year and where they're at in that stack ranking, just to avoid the frustration of dealing with somebody that's learning the process at the same time you are.
No, great advice.
There's a couple of other SBA benefits that I want everybody to be aware of. The first is called SBA's Expansion Financing Program, and it's essentially an SBA 7A loan specifically to a business that's expanding within their industry. So whether that means you're expanding by buying a building or buying a competitor or buying a supplier or a distributor, it's expanding your current business. And when you do that, the SBA does not have any specific down payment requirement, which means that we can do that acquisition or that building purchase for little to no cash down payment and allow you to preserve that liquidity to operate your business. So if you're ever looking at expanding and the cash injection is a potential deterrent, just know there's probably a really good solution to work around that.
John, can you take a question real quick?
Sure.
What's the interest rate gap between the conventional financing and SBA paper?
It's a really good question. Candidly, it depends. If there's a conventional loan, it probably has collateral. It's either fully backed by accounts receivable or real estate or equipment. And in that case, for a business loan, most of those are going to be between 4 and 6% today.
Okay.
On the SBA front, you're probably going to have a collateral shortfall and be between 5 and 6%. So it's not significant. The major difference is your conventional loans are going to have a much shorter amortization. So for an acquisition, typically between 3 and 5 years, whereas the SBA loan's 10 years, which makes your payment significantly less on the SBA financing piece.
Got it.
Good
Thank
question. You. Yeah. One more SBA enhancement, I'll call it. A handful of banks have made the decision that when they're looking at larger transactions over and above the SBA's $5 million limit, to go ahead and fund the difference with a conventional loan right beside it. What that allows folks to do is do acquisitions upwards of $5 million under very similar terms to an SBA loan. And it cuts out the need for mezzanine debt, which is typically 8, 10, 12, up to 14% interest, or the need to go find additional equity, which can be even more expensive. So if you're looking at a larger transaction, just know there may be a good solution, and there's a couple of top lenders in the country that are willing to do those at the higher dollar amounts, even without collateral. Good question. What other questions, Ed?
Well, I've been asking them as we've gone along. I guess one of the questions that we regularly get is value and the process, and the underwriting process. Has anything changed? What next week we're going to be talking about valuation, but from an SBA standpoint and your SOPs, what if anything has changed in that process?
Really good question. I'm really glad to say that from a credit policy perspective and an SBA SOP perspective, there hasn't been any changes. That being said, I think we can all agree that 2020 was an anomaly from a cash flow perspective. Now, it was just a unique year in every way, and some businesses were hurt by it and others greatly benefited. What I'm hearing from many of the valuation companies is that they're not going to focus on 2020 from a cash flow perspective like they normally would. To a large degree, there's going to be projections for 2021 and beyond based on the last couple of months of profit and loss statements. And there'll be a focus on those projections more so than on the anomaly year of 2020. Is that your understanding as well, Ed?
Yeah, I mean, and that's what we'll get into next actually next week for our seller webinar, is that, you know, it depends. I mean, what we're experiencing is those that have survived or thrived in this environment. You know, there's a question whether or not, you know, does the business warrant a premium? And, you know, from an appraiser standpoint, it's more of it depends, and it depends on, you know, what does 21 look like and 22 look like? You know, does and to your point, I mean, it is about projections, but the challenge really becomes, you know, we just found out that pandemics aren't necessarily, you know, in your risk profile, but there's probably something else that could potentially capsize your business. So we and just recently the deal stats the deal stats survey results came out, and there has not been a whole lot of volatility in the multiples. Not that that should surprise anybody, but if anything, they've gone up a little bit. But again, I think that probably has a lot to do with access to capital, which we're grateful for the SBA and folks like you because of it. Yeah, so value, I'm not certain. I think, I don't want to say it's status quo. I mean, we're looking at non-recurring income or non-recurring expense associated with the pandemic, and let's all move down the road. Go ahead.
I think that the only thing I would add to that is that there's some businesses that were shut down for 3 or 4 months in 2020, and we wouldn't expect the cash flow on the 12-month tax return basis to look like it otherwise would.
Sure.
And so I'm willing to throw out the 2020 tax year when I'm looking at my debt service coverage analysis, as long as the last couple months of 2020 are substantially on par with the last couple of months of 2019. In other words, it's okay if my annual analysis doesn't look like it normally would, as long as I can show we're back on track in the last few months. And I think that's important to keep in mind as buyers are looking at financials and trying to make sense of them, that lenders aren't going to be as strict on that 2020 tax year.
Right, and one of the things that we're now seeing is that, you know, PPP money is coming in as other income, and you know, people are appalled when I pull it right back out. That you know, that's, you know, it's like, what do you mean? Well, that got us to profitability. Well, you know, that it happens, but that's a non-recurring income, so that's why we pull it out. As far as the buyer profile goes, is it, you know, does it differ now? I mean, we've talked about the business. The business hasn't changed, other than, you know, all right, we're going to throw out 2020 and perhaps some of the non-recurring event stuff. So what about the buyer profile? What do they have to look like, and has any of that changed?
Great question. Really, it hasn't changed. We're still looking for translatable experience, meaning, have you managed a similar number of people or a similar sized budget to the business you're looking at buying? It would be great if you'd done it within the industry, but it's not mandatory, as long as we feel that the skill set can translate between buyer's resume and what they're looking at doing going forward. From an equity injection perspective, it's still a 10% target. 10% in the SBA SOPs, but up to half of that can be from a seller note that's on full standby, meaning no payments during the life of the SBA loan. So the flexibility to get a buyer in for minimal cash down payments still there, and we're absolutely happy to talk to buyers and be prepared to issue pre-qualification letters for them on a business by business basis as they find new opportunities.
Yeah. One of the questions that has come up is, can you talk a little bit about the SBA and its how it reacts or how it can support an ESOP, either the formation of or the buying out of?
I am not an expert on ESOP financing. I will tell you that it can be done. I will tell you that we still look for personal guarantees to 20% or more owners, but very often in the ESOP situation, there is no 20% or more owner. And that's okay. We can move forward without a personal guarantee on those transactions if that's how they're structured. And that's a fairly new rule within the last 24 to 36 months. ESOPs used to not be eligible for SBA financing, and now they are.
But the requirements associated with becoming an ESOP probably still remain, regardless of the financing, to put it in place. If you don't have X number of payroll expense or particular size, I know that there are a number of triggers that make a ESOP a favorable exit alternative for the business owner. But regardless, and I think that's what and I'm trying to think through, because of the requirements associated with maintaining an ESOP. I'm wondering how that falls into the SBA and its underwriting and the things that you have to do, because I mean there's some substantial compliance matters that usually I think it roughly runs about $100,000. I mean, it's not a cheap undertaking. So my point to you is, and that's maybe something we should explore a little bit more on, whether or not, how does the SBA, how does that affect the SBA? Or I suppose you could bake the expenditure and the compliance into your forecasts, and then the SBA can do their thing to do the financing, right?
Absolutely. We would take that both upfront expenditure and the ongoing compliance expense into our forecast. We're probably going to provide sufficient working capital to cover those costs and make sure it's built into the cash flow model going forward. So,
but I know we're getting ready to bump up on time, but what are the landmines that you're seeing? We'll first start with the sell side. What are the sell side landmines that you just keep shaking your head that somebody keeps stepping on them? So what are they?
So the one I see 2 or 3 times a day right now, you mentioned earlier, they still have their PPP money on their P&L. They're treating it as income, and they're trying to apply 2.5 or 3 or 3.5 multiple to that number. And you can just blame that on me when you help them back that out. But as buyers, if you're looking for a non-brokered business, or a buddy shows you something, hone in on that. Ask them where that PPP number is, and get that kicked out quickly, and then go to Ed and ask for his opinion on value. The next one is simply trying to normalize cash flow over the last 12 months. And it probably requires an additional conversation or two between broker and seller, or your lender and seller, to really try to understand what percentage of the clients are still there and how many ongoing purchasers, buyers are still in place. and understanding how to project that cash flow going forward, because it impacts both the bank's debt service coverage calculation and the potential business valuation. The third one is really understanding the labor force in any particular industry. And, sufficient labor has always been an issue, but during COVID, depending on the industry, it's had an impact, and we need to understand the business's ability to find employees when needed and make sure that's not going to be a challenge for the buyer.
Speaking of which, can you? I know there's some tax credits out there. Can you mix and match? SBA work with tax credits coming from another regulatory body?
It's a really good question. I will tell you that we're not going to get in the way as SBA lenders of a buyer or seller looking for various tax credits, but unless it's already happened, it's difficult to pull into my cash flow analysis. So we can't do a transaction because that tax credit's on the way and it makes the deal work, but we're happy to do transactions and then see our borrowers benefit from those tax credits down the road.
Got it. Okay. Well, so we got 3 landmines from the seller side. Now to the buyer. I'm certain there's more than 3.
So this is similar advice to what I would have shared prior to COVID, but probably more important. Pull a personal credit report. Make sure there's nothing weird going on. A lot of folks that believe they've never missed a payment in their life now have deferred mortgages or deferred student loans or something that a lender tried to do to help them during COVID, but maybe they're not quite reporting it the way you expect them to. I've seen a few of these where they're just reported as missed payments, and we're happy to work through those things, but it's a lot better if you're aware of it rather than getting a phone call from me and it sounding like a surprise. The next piece is those down payment funds. Make sure they're isolated. They're at a point where you can point to them and say where they're coming from. Hearing that they're coming from 10 different sources and partially gifts and partially coming out of retirement accounts and partially other places is all okay. There just needs to be a plan so that we can trace those funds and have a smooth closing process rather than a whole bunch of extra paperwork to track down as you get closer. And probably the last one is there's a lot of buyers looking right now. Try to hone in on the industry and the geographic area you're focused in. It's really difficult as a lender, or I would imagine as a broker, to show somebody the right listings as soon as they become available. If they haven't yet articulated, I want to buy a distribution business and these zip codes or this part of the state. I understand there's a need to start broad and learn what's available, but the sooner you can really narrow down what you're looking for, I think the better chance there is of somebody from Ed's office being able to say, hey, this listing's coming on board next week. I want you to be aware of it because it's exactly what you're looking for. So give yourself the best chance by being the most specific in what you're looking for.
Yeah, and I think the couple things that I'd add is that just because if your business was not tarnished by COVID, that does not mean that your business is necessarily a premium. And from the sell side, just because the credit is plentiful does not necessarily mean that the lender is going to enable you to make a poor value decision. And I think that's one of the things that I think is really challenging right now is, there's, when credit's plentiful, the values go up. But to me, I'm not certain that values necessarily go up for deals. I think that it makes it easier to do deals, not necessarily it amplifies value. And conversely, I think that with the sellers, I think that COVID did nothing but heighten that, here's here are the risks associated with business and how a pandemic or how business interruption affected your business. And to be honest with you, I think a lot of these businesses that are coming out the other end are coming out stronger and have been stress tested. So that's the only two things I'd add on your landmine or my landmine questions that you answered.
It's a really good summary. Thank you.
Okay, so if I'm looking at the chat, I think we've addressed everything that's been asked. I'll make a last call, and while I'm last calling, I will go ahead and do some end of webinar housekeeping matters. As I mentioned before, we'll be sending the links out to everything that we talked about today, the slide deck as well as the recording. If for whatever reason you need to have an exploratory conversation with John or me, we're happy to do it. We've been doing it for an awful long time. And like I said, we haven't been in business this long, either one of us, without having an open shop and having lots of conversations before anybody necessarily pulls the trigger. So I don't see any more questions in the chat. So John, as always, my man, it is such a delight to visit with you. I'm sorry you're so busy we can't see you in person, but we look forward to that time when we can. So thanks again for all your information, man. Thanks again.
Likewise. Thank you so much for the chance to share.
All right. Well, thank you, everybody, and we'll see you next week for our seller webinar.